Okay, let's take a deeper dive into interest rate swaps now. What drives interest rate swaps? Why is the market so big? In fact, they're the largest class of derivative products, 470 trillion notional, is traded on interest rate swaps globally. That's according to ISDA. And that was their report in the middle of last year. So this huge market is driven by differences in international accounting standards, because banks use mark-to-market accounting, but most other companies use cash accounting. So in cash accounting, this records transactions in the balance sheet only when the cash actually changes hands. Income and expenditure in the balance sheet is only there when received and paid. But when the auditors come in and to audit the accounts, they also have to review future cash flows, and they need to discount those future cash flows to today. And they will use fixed rates to discount the cash flows. Mark-to-market accounting records the value of all the assets and liabilities in the balance sheets based on their current market prices to reflect real-time changes. That's why it's mark-to-market. You look at the Bloomberg screen or the market, as long as it's liquid, and you can see what the price is. And then you can see the value of assets and liabilities in real time. Now, cash flows are always discounted using a fixed interest rate when you audit the company accounts. So if you've got a cash flow which is a fixed rate cash flow, for example, it's a fixed coupon bond, well, these cash flows are known and they can be provisioned for. Because if they're anything that's known, it's not uncertain, it's not risky. But floating rate cash flows from a floating rate bond, they are risky because we don't know how much the cash flow amounts will be in the future. But if you know exactly how much is coming in the future and you discount that using a fixed rate, there is really no uncertainty. It's all expected loss or profit, which can be provisioned for. Now, it's the opposite in mark-to-market accounting. Future cash flows are discounted using a floating rate, which reflects the credit rating of the cash flow payer. So, for instance, a cash flow in 2 years' time from an AA rated UK company called XYZ should be discounted at the UK reference rate plus the UK 2-year AA spread, depending on what they are at that particular time. So suppose the cash flow is a coupon from a floating rate note issued by this XYZ. So the coupon you get will be based on the same reference rate and also the same 2-year AA spread, if it's a 2-year floating rate note. So the cash flow that you well, it's a 2-year, well, notes normally wouldn't be 2 years. So shall we say floating rate bond? I'll correct that in the lecture notes when I upload them again. So anyway, the coupon that you get is based on the same reference rate that the bank uses to discount it. So in general, under mark-to-market accounting, if you've got a floating payment, which can vary up and down, but then when you discount it, you're using the same rate that you use to accrue it, you use to discount it, then you know what it is. So floating cash flows are less risky than fixed cash flows. So an interest rate swap changes floating to fixed rate payments, as we've seen when we look at the cash flows. A pays fixed, receives floating. So it's swapping fixed for floating payments. And the loan desk on a bank likes floating rates on its balance sheets because these aren't risky. because it uses mark-to-market accounting. It doesn't like fixed rates on its balance sheet. But companies don't want floating rates, they want fixed rates. So a company could get a floating rate loan from one bank, but then go to swap it with another bank or even the same bank to make the floating payments into fixed rate payments by receiving floating rates on the swap and passing them on to pay off the loan. So this is a diagram of how it works here. So a company gets an 8-year loan for $1 million, shall we say. That's not the nominals not put here, but say it's $1 million from Bank A. And it's for 8 years and they have to pay LIBOR plus 1%. And this is a floating rate because LIBOR isn't known. And I says LIBOR is not much used now, but it could be the SONIA overnight rate plus 1%. But if the company enters an 8-year interest rate swap, so it needs to be the same period as the loan with Bank B, and say the swap rate is 7% that they agree. I'll explain how to get it in a minute. So they could swap fixed payments of 7% on some notional, 1 million in this case, and get LIBOR, and then they'll pay that LIBOR to Bank A. So in the end, they're paying actually 8% interest, fixed interest though, for 8 years, because they have to pay 7% there, and there's an extra 1% for the spread they have to pay above LIBOR to Bank A. So how do we calculate swap rates? Well, as I said, the two counterparties are typically a bank and a company. And in an interest rate swap, the fixed payments R% will be swapped for floating payments, shall I call them RI% on a notional amount, up to a certain maturity. Floating payments are typically, as I said before many times, is at some reference rate plus the spread, which depends on the credit rating of the person paying the floating rate. The swap rate is fixed so that the net present value of cash flows is 0. That's how they're fixed. Every time there's what we call a reset date. So if swap payments are quarterly, then the swap rate is decided at the beginning of a quarter, and the reference rate is revealed at the end. And you use the whole curve of forward rates to fix that swap rate, which I'll explain in the next slide. And every time there's a reset, a new swap rate is calculated so that the net present value of payments over the remaining life is also 0. So you'll see this spreadsheet in on the Canvas site, and let me now show you what that does. So you should be able to see the spreadsheet here. Anything red you can change, anything blue is an output. So it's got a formula behind it. See this formula here. So the swap rate is the sum of the present value of the floating payments divided by the present value factor, the sum of the present value factors for the fixed, floating over fixed. So how does this work? Well, you have some notional amount which you can change. You can make it 100,000 if you want, or anything. Swap rate won't change, but these payments will change. Discount factor won't change, but the actual payment, which is calculated as 5%, but it's a quarterly 2-year swap this. So 5% to 1/4 of 5% times the nominal. And it's floating, so it depends on the specific rate. So here it's using this rate. Here it's using this rate. And you can change the forward curve if you like. For example, we could make this 3%, and then, 3%. And then we could, for example, make this, say, 0.2%. So it's a gently sloping upwards, sloping yield curve. And then the swap rate will change as well. It doesn't change if you change the nominal amount, but it will if you put in a different forward curve. So the floating payments are just the forward rate times the nominal amount. The floating payment is this is the present value, so you discount that. Okay. And then with the present value factor, you discount this fixed rate. C2 is the discount factor, and we don't know what the rate is. It's down there, but we're going to always, if we knew it, we'd put it in here like we did for the floating payments, but we don't. So I just call it a factor. It's not the actual payment. Okay, but it would have, as opposed to the floating payments here, which have different, basically, this one has that interest rate, this one has that interest rate, and this one also, therefore, has that interest rate. This one is always going to use the same swap rate. So we just take the sum of these, divide one by the other, and that gives us the swap rate. And just to explain that calculation, there's period, which is 1, 2, 3, 4, 5, 6, 7, 8, as you can see here. This represents quarterly payments over 2 years. And then you've got the 3-month forward rate yield curve, but this is all in annualized form, as always, quoted in annual. Even though it's a 3-month forward rate, it's annualized, so that's why you multiply by 0.25. Then you've got your discount factor, and you've got your floating payment, and then the present value factor is also times the notional here. Should have put in times notional. I'll correct that on the slides. So you've got the DP times your floating payment, that is FP. Another little typo there. Sorry about those 2 typos. There won't be when you look at the slides. This is actually FP, and this has to have times notional in here. And then the net present value has to be the same both sides. So the sum of the present value of the floating payments has to be the sum of the present value of the fixed leg payments. And these present value factors are all multiplied by the swap rate. So you've got the swap rate times the sum of the PV factors on the fixed leg equals the sum of the PV factors of the floating payments. And because the swap rate is constant, you can take it out and divide by the sum of the PV factors. So that's how it's calculated.